Wow, this is just crazy. Okay, let's dive right into this. Welcome back to another explainer, everyone. Today, we are looking at a company that has been on an absolutely wild, completely unpredictable ride over the past 12 months. I'm talking about Ondas Incorporated, ticker symbol ONDS. If you have been watching the market at all lately, you might have seen this stock literally go parabolic. We are talking about soaring 944% over the last year. That kind of growth is almost unheard of outside of extreme crypto runs. But suddenly, out of nowhere, the brakes got slammed hard, and the stock recently pulled back 18% year-to-date. I mean, what is actually going on here? How does a company shoot up nearly 1,000% and then suddenly start bleeding out? To help us make sense of this roller coaster, cut through the noise, and figure out what is really happening behind the scenes, I'm joined by our chief investment analyst.
It is great to be here, and you are exactly right to be asking these questions. The news headlines are screaming about these massive, astronomical gains, followed by sudden, stomach-churning drops. But as always, the actual truth of this company's valuation doesn't live in the headlines. It lies deep inside the raw data. We are not here to speculate or guess today. We are here to look purely at the numbers, the balance sheet, and the actual contracts they are signing.
To figure out if this recent pullback is a massive buying opportunity or a glaring red flag, we are going to follow a strict four-part roadmap today. First, we will look at the OND stock roller coaster. Second, we will dive deep into their financials, comparing their growth against their current valuation. Third, we'll analyze their moat and the mega trends driving their industry. And finally, we will lay out the future scenarios and deliver a verdict.
Perfect. That is a completely logical step-by-step approach. Let's jump right into stage one.
All right, part one, the ONDS stock roller coaster. Let's look closely at the recent price action and figure out how we got here. So let's put this incredible run into perspective. A $10,000 investment in Ondas a year ago literally turned into an incredible $104,000 at its absolute peak. For context, if you put that same $10,000 into the S&P 500, you would have walked away with maybe $12,400 in that exact same time frame. But recently, the reality check hit. We saw the stock drop 18% year-to-date, pulling back down to around the $9.06 level. Why is a company that just made its early investors extraordinarily rich suddenly dropping off a cliff? And honestly, before we even get to the stock chart, wait a minute, what exactly does Ondas even do? If you look at their corporate overview, it is filled with all this jargon like aerial intelligence and multi-domain leadership. That is just way too complicated. If I'm an elementary schooler, how do you explain what they actually sell?
That is a crucial starting point. What you are seeing on the stock chart is a classic case of market sentiment cooling off after a parabolic run. When a stock multiplies its value nearly 10 times over, the market transitions from buying based on pure potential and excitement to demanding absolutely flawless execution. But to understand how they plan to execute, let's simplify their business model. At its core, Ondas is merging two worlds that used to operate completely separately into one unified package. They call this layered ISR, which stands for intelligence, surveillance, and reconnaissance.
To put it simply, think of layered ISR like building the world's smartest, fully automated neighborhood watch program for major industrial and government clients. To make a neighborhood watch work, first, you need secure walkie-talkies so the guards can communicate instantly without anyone listening in or hacking the signal. That is the first half of the company, Ondas Networks. They build private, mission-critical wireless data systems. Second, instead of paying human guards to walk the perimeter, you have automated security drones that literally fly themselves out of specialized boxes, patrol the entire area, gather high-definition video and sensor data, and then return to their box to charge without a human ever touching a joystick. That is the second half, Ondas Autonomous Systems. Oh, wow, okay, that makes so much more sense. So they're essentially providing the ultra-secure communication walkie-talkies and the automated flying robot guards as one single bundled package. They aren't just selling a random drone to a consumer. They are selling an entire end-to-end automated security infrastructure for massive organizations. And looking at this, it brilliantly illustrates exactly how far they have scaled that infrastructure. They aren't just testing this out in a single backyard or a small facility somewhere. They have a massive global footprint, actively operating across over 45 different countries. So they clearly have the cool, futuristic tech, and they obviously have the global reach. But the billion-dollar question for our stock accounts is, how does that actual physical footprint translate to the balance sheet?
That is the exact right question, and it brings us precisely to the second stage of our analysis. It is time to look at the raw math from their most recent financials.
All right, moving right into stage two, financials, growth versus valuation. Let's weigh their actual revenue growth against what the market thinks they are worth. we need to look closely at their first quarter 2026 earnings report because the results were, by all traditional growth metrics, absolutely staggering. They reported revenue of $50.1 million. Now, to truly understand the scale of that, we have to compare it to their past performance. In the exact same quarter last year, they reported just $4.2 million in revenue. That is a massive, highly unusual 10-fold increase year over year. It is also a 66% jump just from the previous quarter, which completely exceeded the high end of their own internal guidance. But the data shows this isn't just a one-off fluke or a lucky quarter. Their pro forma backlog, which is the total value of confirmed contracted orders they haven't fulfilled yet, surged to an unbelievable $457 million. That is up from just $68.3 million at the end of 2025. Wait, seriously? Let me make sure I'm hearing this right. A literal 10x jump in revenue in 1 year, and a guaranteed backlog of almost $500 million just waiting to be processed? And wait, I remember reading in the reports that they are currently sitting on $1.48 billion in cash and short-term investments. That is an absolute war chest. But here is the devil's advocate question, because this is what every viewer is thinking right now. If they are making so much money, if they just secured a massive $457 million backlog of future revenue, and they're sitting on a literal mountain of $1.48 billion in cash, why is the market punishing the stock? Why are we seeing an 18% year-to-date pullback when the top-line revenue growth looks absolutely flawless? What is the catch here?
The catch is all about expectations. As investors, we do not buy a company's past performance. We are exclusively buying its future cash flows. And right now, the market is aggressively weighing the heavy cost of maintaining that hyper growth. Let's look closely at the valuation warnings hidden beneath that revenue, specifically their multiple and their cash burn rate.
The entire tension of this stock is perfectly outlined in these metrics. Yes, the data shows they have $1.48 billion in liquidity. That is a massive safety net, which guarantees they won't face any immediate financing pressure or need to dilute shareholders to keep the lights on. However, because of that parabolic 944% stock run we talked about earlier, their price-to-sales, or PS ratio, recently hit an astronomical 36.3. For context, their historical 5-year average is just 10.6. A 36.3 multiple means the market has essentially priced in absolutely perfect execution for the next decade. If there is even a slight hiccup, that multiple will compress. Furthermore, generating that impressive $50.1 million in revenue is intensely expensive right now. Their total cash operating expenses for the quarter were $36.9 million. That includes $13.2 million at the corporate level and $23.6 million at the autonomous systems level, just to keep operations running.
Wow. Okay, hold on. $36.9 million burned in a single quarter purely on operating expenses? That is extremely heavy. So what you're saying is, sure, their top-line revenue is exploding, and their gross profit margin might have even risen, but the actual day-to-day costs to run this giant corporate machine are just eating all of that cash right back up.
And I think this brings us perfectly to this critical quote from the analysis. Corporate-level losses remain elevated despite subsidiary progress. So basically, what you just said means they are bringing in a ton of money through the front door, but the incredibly complex machinery required to manage all these different drone and network subsidiaries is so expensive that actual bottom-line profitability has been pushed all the way out to 2028. And if there's one thing Wall Street investors absolutely hate, it's waiting until 2028 to see a real profit.
Precisely. The numbers don't lie. They reported a total operating loss of $42.6 million for the quarter. So the market is asking a very rational, mathematically sound question right now. Can Ondas actually streamline this massive, sprawling global operation and become profitable before they burn through that entire $1.48 billion liquidity buffer? To answer that, we have to look outside the balance sheet. We have to evaluate the macroeconomic forces pushing them forward and what their unique, irreplaceable competitive advantage actually is.
Okay, so the financials paint a picture of incredibly high risk, but incredibly high reward. Let's move to stage 3, the moat and megatrends. Let's look at the industry tailwinds that could actually justify this valuation. To justify a 36 times sales multiple, a company cannot just rely on good salesmanship. They need a massive, undeniable wave of industry demand pushing them forward. And the data shows Ondas has exactly that. Look at these macro tailwinds. First, regulatory enablement. The FAA is currently establishing rules for BVLOS, which stands for Beyond Visual Line of Sight. This is crucial. In the past, drone operators had to physically see the drone, limiting its range. BVLOS unlocks scaled commercial autonomy. It means these drones can finally operate dozens of miles away from humans legally, totally changing the economics for logistics and public safety. Second, there is a massive domestic deployment pull-through. The data shows $500 million in Department of Homeland Security funding specifically allocated for counter-UAS, or counter-drone, installations ahead of the upcoming FIFA World Cup in the U.S. Third, industrial policy. Buy American and NDDA compliance rules are aggressively shifting U.S. defense and infrastructure procurement away from cheap foreign competitors, completely locking out Chinese drones and funneling that capital directly toward domestic suppliers like Ondas.
So let me get this straight. The government is literally rewriting the aviation rules to make long-range drones legal, banning foreign competition, and physically cutting $500 million checks to mandate this technology for major events. That is a massive, almost unfair setup, and Ondas is perfectly positioned to just catch all that cash.
Exactly. And the undeniable proof of that demand is their strategic program pipeline. Ondas is currently pursuing a staggering $4.3 billion in tender submissions globally across more than 45 active programs. This isn't theoretical, maybe someday demand. This is active, ongoing bidding right now. The pipeline data is split between $1.78 billion in the United States and $2.05 billion in Europe, targeting massive, multi-year defense contracts. We are looking at specific, high-value pursuits, like a $982 million U.S. lethal unmanned system program and a $300 million NATO Eastern Flank long-range autonomous strike platform.
Oh my gosh! Over $4 billion in the pipeline. That is mind-blowing. But wait, doctor, let me play devil's advocate again. The defense sector is an incredibly crowded space. You have massive prime contractors like Lockheed Martin and Northrop Grumman out there. If Ondas is bidding on hundreds of millions of dollars in NATO and U.S. border security contracts, what makes them so special? What is their actual irreplaceable weapon, their economic moat, that stops a bigger company from just copying them and taking those contracts?
Their primary moat, particularly in the highly lucrative counter-drone space, is a proprietary technology they acquire called Centrix. To understand why it's a moat, look at how the industry currently operates. Traditional counter-drone tech relies on legacy jamming, basically blasting a massive area with radio noise to sever the connection and knock an enemy drone out of the sky. The problem? Jamming is a blunt instrument. It disrupts friendly communications like airport Wi-Fi or police radios, it causes constant false alarms, and a disabled falling drone creates dangerous physical collateral damage. Ondas Centrix uses something entirely different: protocol manipulation, which is often referred to in the industry as CyberRF. CyberRF, honestly, that sounds like something straight out of the Matrix. How does that actually work in the real world? It is highly sophisticated, and the data proves its efficacy. Instead of blindly jamming radio waves, the Centrix system autonomously detects the specific serial number and communication protocol of a rogue drone. It then uses targeted cyber techniques to literally hack in, disconnect the drone from its original operator's controller, reprogram its internal home location, and force it to land safely in a pre-designated secure zone. There is absolutely no jamming interference, no false alarms, and zero physical collateral damage. If you are protecting critical infrastructure like a crowded commercial airport, a nuclear power plant, or a packed FIFA World Cup stadium, this level of surgical precision isn't just nice to have, it is absolutely irreplaceable. That is incredible. So they can literally hijack enemy drones out of the sky safely and take total control. That is an undeniable moat. All right, we've seen the financials and the tech. Let's move to our final stage, Part 4, Future Scenarios and the Verdict. Let's talk about where this stock goes from here. As an investment analyst, I do not deal in certainties or crystal balls. I deal entirely in probabilities based on the data. Based on the metrics we just reviewed, we have modeled 3 strict survival scenarios for Ondas over the next 12 to 24 months. Let's start with the bull case, the optimistic scenario. Here, Ondas perfectly executes its strategy. The core precondition for this is successfully converting a significant portion of that massive $4.3 billion pipeline into confirmed orders, particularly the high-margin Centrix counter-drone systems we just discussed. Management recently raised their 2026 revenue target to at least $390 million. That would represent a 670% year-over-year increase. If they hit that specific target, the math changes completely. The currently inflated price-to-sales ratio suddenly compresses naturally into a very reasonable multiple because the sales denominator grew so fast. The stock would likely close its current valuation gap, rapidly climbing to reach the $1950 fair value that most institutional financial models currently project.
So basically, if they do exactly what they promised, convert those defense contracts, and deliver that $390 million, the stock could realistically double from its recent pullback level. But as we know, that requires absolutely perfect execution. What happens if they just perform adequately? What is the middle ground here?
That brings us to the base case, which, statistically speaking, is the most likely future based on current data. In this neutral scenario, Ondas relies heavily on its massive $1.48 billion liquidity war chest to comfortably fund its operations without needing to issue new stock. They steadily and methodically burn through their already confirmed $457 million backlog. In this scenario, they might miss that highly aggressive $390 million yearly target, but their overall revenue growth remains very solid and completely uninterrupted. The stock likely digests its recent 900% run, meaning it trades sideways or experiences mild, stable growth as they coast safely toward their promised first quarter 2028 adjusted EBITDA profitability target. The sheer size of their cash position perfectly protects them from macroeconomic shocks. Okay, so the base case is basically they survive off their giant cash pile and slowly, steadily grow into their massive valuation over the next few years. But as the devil's advocate, I always want to know the absolute downside. What happens to our stock accounts if the wheels completely fall off? The bear case represents the worst-case situation where the underlying risks materialize. The critical precondition here is that execution severely stalls. Perhaps those multi-billion-dollar government contracts are delayed due to budgetary gridlock. Or perhaps physically integrating their newly acquired drone subsidiaries proves far too complex. If revenue growth slows down even slightly, the market will absolutely not tolerate a 36.3 price-to-sales ratio. The data shows that the multiple will violently collapse back down to its 5-year historical average of around 10.6. Compounding this, if they continue burning that $36.9 million a quarter in operating expenses while top-line revenue stalls out, that $1.48 billion cash buffer will start looking much smaller very quickly. That combination of multiple compression and high cash burn is the exact trigger for widespread panic selling among institutional investors. Wow. So basically, the stock gets cut into a third if the market decides to value it like a normal everyday company while they are still burning millions in cash. High risk, exceptionally high reward indeed. It all comes down to whether they can execute before the market loses its patience. And I think this quote brilliantly illustrates exactly where Ondas is right now. Benjamin Graham, the father of value investing, famously said, "In the short run, the market is a voting machine, but in the long run, it is a weighing machine." Essentially, the market voted Ondas up 944% purely on hype, momentum, and the massive potential of automated drone security. But now, the weighing machine has officially arrived. Ondas has to put those $50 million quarters and that $457 million backlog on the scale and mathematically prove they can reach actual profitability before that cash runs out. It is a truly fascinating setup, and we will be watching it closely. Thank you for watching today's Explainer, everyone. Your subscriptions, likes, and supportive comments are a huge encouragement for our Explainer production. Keep learning, stay focused on the data, and we will see you on the next deep dive.